Hello, everyone. Today we'll be talking about certain accounting terminologies as we did in my previous video where we talked about assets, liability, and equity or capital. Just a recap of what we did in my previous video. We said assets is something the business owes. It's something the business owns or can use. It's like a property that belongs to the business. And we talk about liability. We said liability is a debt. It's a debt. It's like borrowing from someone or using someone's property. And we said equity. Equity is what the owner of the business has invested into the business. So the business is owing the owner. Like the business has borrowed from the owner. That's what equity means. Today we'll be looking at another terminology, which is revenue. Revenue is the income generated by the operations of a business for a period. So revenue is the income generated by the operations of a business for a period. So revenue is like sales. Is the income. When you sell, you get an income. So it's the income the business has generated by the operations. So when the business sells their goods and services, they generate income. So sales is a form of revenue. So sales is a form of revenue. And we have another terminology is expenses. Expenses are the cost of running the business in the same period. So expenses are the cost of running the business for the same period. So expenses are the cost we incur in our daily operations. For instance, we have the rent expense, like the money you pay to rent the buildings you use in your daily operations. We have delivery or transportation, T&T transportation. We have a lot of expenses, yeah. So revenue is the income generated by the operations of a business for a period, and expenses are the cost of running the business. So we've talked about assets, liability, capital, revenue, and expenses. And now we'll be going into an interesting topic. Like, we'll be tackling something interesting that I think for you to be a good accounting student, you need this to be a good accounting student. As we talked about assets, and we said asset is more or less like a property, something the business owns. So for accounting is built on principles and rules. And I want you to pay attention to this concept or to this principle. Assets, it's something the business owns. Something the business owns. So it could be example of an asset. It could be land. The business owns a land. The business owns a building. The business owns some cash or has some cash in the bank or some cash in the office, etc. It goes on and on and on. So with accounting, we have the debit and credit side. So let's look at the T account. So an asset. So we have T account. So let's say this is the asset account. We have the debit side. The debit side, which is on the left side of the T account, and we have the credit side, which is on the right side of the T account. For assets, it increases at the debit side. It increases at the debit side. So it increases at the debit side, and it decreases at the credit side. It decreases at the credit side and it increases. So anything that increases the asset is recorded at the debit side. So it is recorded here. And anything that decreases the asset is recorded here at the credit side. So if land, assuming if land, or let's say if the cash of the business increases, we will record it here at the debit side. And assuming if the cash, which is an asset of the business, decreases, it will be recorded at the credit side. These are principles. They are rules that you need to memorize. Like you need to memorize. You need to know that assets increases at the credit side and it decreases at the debit side. And now let's look at liabilities. I said liability. Liability means you've borrowed from. It's a debt. You've borrowed from someone. It's a debt. It's a debt, and you have an obligation to pay back. You have an obligation to pay back. To pay back that debt. So you do not own that resources. That resources doesn't belong to you. It belongs to someone and you are using it, and you would have to pay the person. So the principle behind, so the rules or the principle behind liability with the T account. So a liability could be like you are owing a supplier. You owing a supplier, like someone has supplied you goods on credit. You've not paid the person, so that's one of the examples of a liability. As you said, with the T account, the debit is on the left side and the credit is on the right side. And with liability, it's not with liability increases at the credit side. At the credit side. So liability increases at the credit side and decreases at the debit side. It decreases at the, so it is the opposite of assets. With assets, it increases at the debit side and decreases at the credit side. But with liability, it increases at the credit side and decreases at the debit side. So liability increases here and decreases here. So it increases at the credit side, increases here, increases at the credit side and decreases here. So assuming you buy on credit from someone, that the person becomes your supplier, liability has increased. So your liability, so you write it here, you record it here. Assuming you pay the person or you pay back, we say liability, you have an obligation to pay back. So assuming you pay back your supplier or you pay your supplier, your liability will decrease. Here. That's assuming your liabilities. Assuming you borrowed, you assuming you have a liability of, let's say, 3,000. So let's say this is the 3,000, and you pay back 1,000 because you've paid back, so your total liability will decrease. So you record the 1,000 here at the debit side, which records all, which we use when liability decreases, and we use the credit side when liability increases. And let's talk about equity. In my previous video, I said equity is a form of a liability. It is another type of liability, But with this liability, we owe the business owner as I said in one of my videos, that the business and the owner are two separate entities. We have the business, we have the owner, and we have the business. They are two separate entities. Like, the business is not equal to the owner. They are two separate entities, the business and the owner in accounting. So the business can be sued and the owner can be sued separately. So the owner gives the business money. So the owner gives the business money. So now the business is owing the owner. Yeah. So that is equity. But with liability, the business is owing an external person, or is owing someone different from the owner, like someone who isn't the owner. That is, so equity follow the same principle as liability because it is another type of liability. So equity follows the same principle of liability. So let's look at the T account for equity. So as I said, debit side of the T account is on the left side, and the credit side and the right side of the T account is the credit side. This is the credit side. And if you can recall, I said with liability, liability increases at the credit side. Likewise, equity. So equity increases at the credit side. So equity increases at the credit side. and it decreases at the debit side. And it decreases at the debit side. So anything that increases equity is recorded at the credit side. So you record it here. Anything that will increase equity, you record it here. And anything that will decrease equity will be recorded at the debit side of the T account. Yeah, so assuming the owner invests more money into the business, it will be recorded here at the credit side because it increases the equity. So if the owner invests more money, it will be recorded here. If the owner takes out money or withdraws money, when the equity decreases, it will be recorded here. In my previous video, I said equity is the same as capital. Yes. So we will look at some few examples. Then I believe by then we will be able to understand the practical part of this concept. And now let's look at, today I introduce you to two new terminologies, which is revenue and expenses. Revenue and expenses. Revenue. I told you revenue are income generated due to the operations of the business. Now let's look at the principle behind revenue and expense. As we already know, debit is on the left side of the T account. The left side is the debit side, and the right side is the credit side. With revenue, it increases at the credit side of the T account. It increases at the credit side. Just like equity and liability. So revenue increases here. And it decreases at the debit side. At the debit side of the T account, or it decreases at the debit side. So it increases at the debit. So revenue decreases at the debit. So any transaction that increases revenue is recorded at the credit side. So if you sell more, if you make more sales, you record it here at the credit side of the T account. And assuming a customer returns the goods they've sold, or if revenue should decrease, you record it here at the debit side of the T account. So these are principles, like you need to know them. It's a must. You need to know them in order to be a good accounting student. So just memorize them, or with time you get to know it. And now let's look at expenses. as I said, expenses are cost. So expenses and revenue are opposite, like the way asset and liability are opposite. So I believe by now you know the principles. So let's see the expense account. So the T account. We know the left side of the T account is the debit side, and the right side of the T account is the credit side. This is the debit side and the credit side. And as I said earlier, expenses is the opposite of revenue. And I said revenue increases at the credit side and decreases at the debit side. So if expenses is the opposite of revenue, what do you think expenses principle will be, or the accounting treatment of expenses? So expenses will increase at the debit side. So expenses will increase at the debit side and decrease at the credit side. So expenses increase here, it will increase here, and it will decrease here. So anything that increases expenses, if you have to pay more rent, you record it at the debit side. And if you have to pay less rent, or if you pay off if your expenses decreases, it will be recorded at the credit side. So anything that increases expense is recorded at the credit side. Anything that increases expense is recorded at the debit side, and anything that decreases expense is recorded at the credit side. So let's summarize everything that we've learned. The principles, let's look at the principles. Let's look at assets. Asset increases at the debit side. So we can say debit equals to increase, and asset decreases at the credit side. So credit equals decreases. And now let's look at liability. Liability increases at the credit side. So with liability, credit equals increase, and it decreases at the debit side. So debit equals decrease. And now let's look at equity, which is another form of liability. It increases at the credit side. At the credit side, that's credit equals increases, and it decreases at the debit side. So debit equals decrease. And now let's look at revenue. Revenue increases at the credit side. So credit equals increase. And revenue decreases at the debit side. So debit equals decrease. Now let's look at the last principle. That's expenses. It increases at the debit side. It increases at the debit side. That's debit equals increase. And it decreases at the credit side. So credit equals decrease. Yes. So these principles or rules, you need to know them. Like, they govern how you treat transactions. So just memorize them, or with time you'll be solving a lot of questions, and with time you get to know them, So just know them. So we'll end today's lecture and we'll continue tomorrow, God willing.